Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. David, it's 1 month on, almost, since the inauguration of President Trump. So we're going to be talking a little bit about where we are in the global economy, US economy, following on from that inauguration on the 20th of January, aren't we?
Hi, Sarah. Morning, everybody. Yeah, let's try and disentangle what's going on with trade policy, with deregulation, with the Trump agenda, and try and make some sense of this from market, shall we?
Yeah, because there's certainly been an awful lot going on. But before we get to that, quick fire numbers round. Do you want to go first?
The problem with the quick fire numbers round is I'm starting to realise it's incredibly difficult to guess accurately what your number relates to. I feel like there should be a disproportionately large prize if we ever guess each other. So we did turn up 1 week with the same number.
We did, yeah.
Right, I'll go first. 98% is mine. I'm going to tell you 98% is the share of global manufacturing capacity that China has laid down to produce anodes for batteries, for high-tech batteries, right? And it's a chart that I posted on LinkedIn. It's a data set from the FT. I think it's an incredible data set. It just shows really what we should be talking about. We'll get into some of this today, which is the headlines are all about China steel and China aluminium. But really, if you look at China's raw manufacturing capacity, it's in battery tech, it's in EVs, it's in solar and renewables. I mean, they have really cornered the market there. 66% of global EV production, 85% of battery cells. China's the workshop for these kind of high-end, high-tech products. So I thought it was a fascinating reality check there, that when it comes to all things battery and all things EV, China's the workshop of the world.
Yeah. Okay. Well, my number is completely unrelated to our topic this week, but it is a topic that's close to my heart. £46.2 million.
Well, it's within the realms of a lotto win, isn't it? I suppose, but I don't think that's a subject close to your heart.
Not particularly, no. Well, it would be if I won, but no.
Come on then, tell me.
It is the price of the second most expensive car that was recently sold at auction. It's a Mercedes W196. It's a Stromlinienwagen, of which there are only 4 built. And I mention it because it's interesting, because I did a podcast, an episode of Need to Know back in the summer of 2024 with Simon Kidston, who was the man involved in the purchase of the most expensive car ever sold at auction, which was another Mercedes. It was an Uhlenhaut coupe that sold for £115 million. So £46.2 million, it's the cost or the price of the most expensive car ever sold at auction.
Really interesting, this, isn't it? There's so many dimensions to classic cars. There's just obviously the scarcity factor, but then there's the provenance and who's driven the car. Really interesting, really good.
Well, if you want to find out a little bit more about investing in classic cars, then that episode I did with Simon Kidston was called Passion Investing, and that was from the 4th of June 2024. But it was fascinating. He was very much involved in the sale of that car, or in the purchase of that car, I should say, for a private owner. But he knows a lot about the buying and selling and the keeping and the driving, importantly, of classic cars. Anyway, all right then. So this week's topic, I was going to say 28 days later. It's not actually quite 28 days later, but it's a month on from Trump's inauguration. We're going to talk about, let's kick off with tariffs first, because that's the big one, isn't it? Because going into the election, there was lots of sort of rhetoric about tariffs. There's an awful lot being announced and perhaps sort of slightly dialed back on since the 20th of January. So I guess, what have we seen so far in this first month?
Yeah, we've got to pick tariffs apart a bit. And we've talked a lot about tariffs the last couple of months, and I've posted quite a bit about them online. What we're wrestling with here is a kind of conflict between a few decades of trade policy economics driven by Nobel Prize winning academics that have basically said that tariffs are inflationary, with more kind of heterodox economists, which are now, I would say borderline mainstream, because they are, by definition, they are now in the Trump administration driving this policy, who are saying quite loudly that no, it's not inflationary, and it's a perfectly reasonable policy choice given how they see global trade imbalances. So I think we need to just pick it apart a little bit and decide whether or not this will be a headwind for economic growth. What does it mean for inflation? And I think the interesting question, which I've been picking apart the last few days, is whether China is actually Trump-proof when it comes to tariffs. Because a lot of people are referencing Trump's first term and the data from that first term as examples of actually why tariffs aren't inflationary. But I think, as we'll discuss, what was actually applied in the first term wasn't as extensive perhaps as what could be applied this year. So look, we've had this first month in office, and look, I'm not going to shock you here. Trump has delivered exactly what many expected: policy turbulence. And the market reaction actually has been remarkably calm, because I think the bond markets and the equity markets sort of stare this down as simply rhetoric and a negotiation tool. But you've had that sort of initial optimism, which was driven by the tax cuts and deregulation topics, and we'll come on to a bit of that in a minute. But I think beneath the surface, if you listen to insiders in Washington and you listen to sort of economists on both sides of the Atlantic, I think everyone is saying the policy environment is just becoming more unpredictable. You've got this kind of pendulum effect between policy being, tariffs being on, tariffs being off, tariffs being on, tariffs being off. And I think the question is, will those policies genuinely benefit the US economy? Or are they likely to damage global supply chains and ultimately US growth and businesses themselves? So that's our topic today. We'll try and break it down.
Okay, your quickfire number round this week sort of highlighted the importance of China from a point of view of EV manufacturing, battery manufacturing. And obviously, Trump's policies are very much targeted at steel and aluminium. So that would suggest possibly then that, to your sort of initial question, China is perhaps Trump-proof. They can actually withstand these tariffs.
Well, China is still a huge global exporter of steel and aluminium. I mean, it is absolutely enormous in that respect. But if you look at aluminium manufacturing capacity, it's around half of global manufacturing capacity, and if you look at steel, it's a little under 45%. So they are massive exporters. But really, when you look at US sort of bilateral trade, you see that it's countries like Canada and it's Canada really, which is sort of 60% of the US's aluminium imports. It's actually America's closest neighbors that disproportionately are affected. US steel imports are around sort of 35 million tons a year, and aluminium imports are around 6 million tons a year. And that amount, so that's the raw volumes. If you actually translate that into a dollar figure, it's about $47 billion of aluminium imports. And that's a fraction of the nearly $3.5 trillion volume of trade in US imports last year. So, these are clearly policies that don't reconcile with the proportionality figures, and they don't do much at all to drive the trade deficit. So I think when it comes to China, there's a couple of interesting charts which we're going to post as our chart of the month, and it shows bilateral trade between the US and its top 10 trading partners. And what you can see, this interesting trend which has accelerated over the last couple of years, and it's the bilateral trade with emerging markets, and particularly Vietnam, has increased massively. In fact, Vietnam's gone from the 5th largest trading partner to the 3rd largest trading partner. Now, why is that? Is that because Vietnam is just miraculously trading more with the US? No, it's most likely intermediate factors of production, Chinese businesses relocating or certainly exporting from Vietnam into the US to get around this bilateral tension. And I think you'll see more and more of that. And what's interesting, if you looked at the trade statistics towards the end of last year, and if we had Howard on last week when we were talking about interactive entertainment. I was chatting to him the other day. He was saying in many of these company announcements and many reports, we see that companies from an inventory perspective have got ahead of potential tariffs by importing a lot at the end of last year. So what am I saying here? I'm saying that supply chains and companies tend to work around these issues.
Is that basically what we're talking about then when people use the expression friendshoring? Because I always thought of friendshoring as you're trading with your neighbor. So if you're the US, you're trading with Canada or Mexico. But actually, it isn't necessarily about your immediate neighbor. It's about whoever is kind of aligned with you from a sort of geopolitical point of view.
Yeah, there's a couple of dimensions. I mean, the geopolitical dimension is driven by policy, okay, and there are just certain relationships or certain areas of the world now which are effectively no-go zones as far as business is concerned, and that's been driven most recently by the Russia-Ukraine war, or more generally by just trade tensions ratcheting up. But friendshoring really accelerated post-COVID. I think what COVID did to businesses is highlight to them very acutely where their supply chains were bottlenecked and where they were concentrated in one particular region. So I think it's about diversification more than a more emotive statement about who's my friend and who's my enemy. I think it's about just making sure that you've not located your entire production chain in one particular country.
Because I read a very interesting statistic the other day, which was research done by McKinsey Global Institute. And they identified that actually, at a global level, the average geographical distance of trade has climbed over the past decade, not declined, by about 10 kilometers a year. And that the average distance a dollar of trade now travels is about 5,200 kilometers, which sort of goes against what I would have assumed with deglobalization and what I understood by friendshoring.
I think what we're getting into here is just how complicated supply chains are, because you've got very established economic models to look at trade. The gravity model of trade is your classic model, which basically says that bilateral trade is increases usually as a function of GDP between two countries and the distance between them, or it's inverse to the distance between them. So basically, anyone that's studied physics out there remembers Newton's law of gravitation. That basically says the larger economies tend to trade more each other the closer they are with each other, and trade decreases as distance increases due to higher costs. There's a few paradoxes here, though. I mean, technology has improved massively, communication has improved massively, shipping and logistics coordination has improved massively over the last couple of decades. So there should be this non-linear effect that means that distance shouldn't be increasing. Distance shouldn't factor in the way that it has done in the past. But it is curious. I think I'm not sure if the McKinsey report arrived at any conclusions, but it is consistent with this idea of diversifying your supply chain away. I think when it comes to trade models, though, and we'll get back to this when we come back to the US, you can look at a particular good, taking in the example of a non-perishable good or a consumer durable good. Like trade distance doesn't necessarily factor heavily in that good. It's more about the economics of the business model and the ability to manage your supply chain. But if you think about a perishable good, then it's completely different. Like there's no point in trading in a perishable good with a country literally the other side of the planet, because there's a simple, just practical aspect of getting something perishable to a consumer. So you've got to look at, I think, individual markets and individual commodities and individual products and look at them through that lens, which is why I think this current trade policy is particularly interesting. And by the way, I think it's only, I think, the lesser half of the big issue here, right? So the US is focused on its bilateral trade deficits with various countries. But really, for me, it's about the capital account surplus on the other side. And the way these identities work, listeners who perhaps aren't familiar with the economics, is current account deficits are effectively capital account surpluses. So if you're running a massive current account deficit, you've got a huge capital account surplus. And the capital account surplus in the US reflects this insatiable demand for dollar assets, the US dollar, US stocks and shares, US treasuries. And I think that is still, that's a huge global force in capital flows. And if you don't change that, I'm not sure you're going to do much about the deficit. It's all about excess savings, excess consumption.
If we come back to this impact of tariffs once more, I want to just reflect back on. So the last time we had President Trump in office, and we have charts, and you say you've posted it on LinkedIn. There's a chart that shows the impact on certain sectors of tariffs, but it doesn't necessarily have a broader impact on CPI. But I know that you had some thoughts on, because I think sometimes tariffs are seen as they're kind of like a one and done. Like, I mean, the washing machine example that you give, it impacts the washing machine, the price of the washing machine, and once it's done, it's done. It doesn't keep happening month on month. But you had an interesting example of the impact on tariffs if you have where you have cross-border production and you have a to and fro across the border to manufacture something, because a part goes over there to have something done to it, and then it comes back here, and then it goes back over there again. There is actually a cumulative impact of tariffs, isn't there?
No, yeah, it's enormous. I mean, the washing machine example is a good one. If you manufacture a consumer durable good at the other side of the world, and then you import it, and there's a tariff all of a sudden levied, that represents a one-off increase in the price of that good. Now, if that good is in a disinflationary trend anyway over multiple decades, which washing machines have, in real terms, washing machines have got cheaper over the last 30 years. So that trend is driven by technology and just scale of production. So your tariff is just a one-off price increase, and then your trend continues. That's very different to where you have supply chains that are very complex. Take one of those complex machines that we've ever built, which is the car that's sitting on your drive.
Yeah.
Okay? The reason it's complex is because there are just thousands and thousands of components that are from hundreds and hundreds of companies, and many of those components have sort of intermediate stages where they are shipped to one firm, something's added to it, then shipped back to the original firm, something added again, and then back and forth, back and forth. And if you look at the North American automotive industry, that happens a lot between the US and Mexico. And there are lots of estimates on this, but a typical US vehicle will cross the Mexican-US border about 8 times during its production.
Wow.
Certainly large components of it will cross 8 times. Now, if you're adding a tariff every time that vehicle crosses the border, you've got an effective tariff rate of, in some cases, around 150%. So that's just a wild, effective, that's pricing that whole product out of the market. And these are US companies as well. So this is why the effective tariffs is very complicated. And it's a similar situation with Canada as well. And I think this is where the China story gets all the headlines, but really it's Canada and Mexico where supply chains are really intertwined and truly cross-border. It's not just a one-off import. So your original question about the first Trump administration and what was the effect on inflation is relevant, because we had tariffs on steel and aluminium back then, and there wasn't much of a spike in inflation. Okay. There were tariffs also on lumber, and there's some good stats out there showing how increased tariffs on lumber caused the cost of building US homes to increase by anywhere between $9,000 and $20,000. So there were inflationary impacts in particular sectors, but generally there wasn't. And I would say the reason there wasn't was because the exchange rate got a lot of those tariffs out of trouble. So remember, the US dollar has been on this appreciation pathway for a number of years, and the Chinese yuan has been depreciating. So if you actually look at the net impact of tariffs in the first Trump administration, they were almost cancelled out by the exchange rate moves. So American consumers didn't feel the impact.
Yeah. And also then, from what you're saying, it sounds like the impact on China's GDP is going to be limited, because yes, steel and aluminium is important for them, but actually what's really important for the global economy is their production of batteries, solar panels, and that sort of thing, more than steel and aluminium.
Yeah, I think that's where you have the true dependency. And the China exports a lot of very rare earth metals as well that are used in all sorts of very high-end electronic applications. So we should be mindful of bilateral retaliation in that respect. If you actually look at the analysis that's been done on China impact, it's quite interesting. I think, I've seen some very good, very complex pieces of analysis that suggests that even with wide sweeping tariffs levied on China by the US, you would perhaps dent Chinese economic growth annually by about 1%. That's not a massive impact. And therefore, the reasons we've mentioned today, that supply chains now, certainly when it comes to Chinese exports, have moved into intermediate countries like Vietnam, as an example, and the kind of materials that the tariffs are being applied to aren't necessarily ones that the US imports. Well, it does import a lot from China, but they imports more probably from Canada and maybe even Mexico. So I think for me, the tariffs pendulum, and it will keep swinging on off, I think, as a negotiation tool. It's Canada, Mexico, and the EU for me that are the big stories. The China one, lesser of a story, I would say. And I still think that point that I can't, I think, labour enough, which is that if you genuinely want to solve the deficit, which I'm not actually sure Trump and his administration do, I mean, that's certainly the rhetoric, you've got to look at the capital account as well. You've got to look at this demand for US assets, which is driving ultimately the deficit.
Yeah. Okay. Well, so that's tariffs, which are, okay, some people see them as not being negative, but I think generally a lot of people consider them being negative. Now, one thing that was seen as being positive for the US economy was this subject of deregulation. How has that, so what, again, let's talk about what was discussed, what was the rhetoric before, in the run up to the election? What's the reality post January 20th?
Yeah, so the rhetoric before the election was one where regulation was held as a principal reason why US businesses were not competitive, couldn't compete, weren't growing. And, Trump singled out, a couple of sectors, financial services and energy were the two he focused on most. And if you take energy as an example, I think this is the one which is, I think, the least easy to understand, because the whole policies towards the energy sector have been formed under the banner of American energy independence and national security. Well, America is energy independent and has been for many years. It's the largest crude exporter in the world. I mean, more than Saudi Arabia, as we discussed just the other week. And I think that if you go back and look at the last couple of decades of oil prices and take a rough average, like the oil price is roughly in line with that average today. So there's no energy crisis in the US. And so this is the one that I think is a bit bizarre, and by bizarre, I mean, it doesn't seem to match with this need for really, really cheap oil. So the energy sectors, had a huge amount of optimism with this idea of reduced compliance costs and reduced red tape. And I think when it comes to regulatory shifts, particularly very quick ones, remember the trade-offs. It's probably a trade-off for growth now, potential risks later.
Yeah.
So I think when I talk about the composition of energy consumption in any advanced economy, I don't think you can pin it on one particular solution. I think the energy makeup of major economies is going to be complex. But should any economy be mining coal as a principal source of energy anymore? The answer to that is no, on multiple grounds. So I'm not sure that energy really needed this kind of deregulation, but financial services has been the other one. And you've seen banks and US financials have a lot of sentiment, and they've done very well over the last couple of months as a consequence of this. I think you've just got to balance this idea of the catalyst for growth with eroding foundations of market stability. And the financial sector in particular requires careful oversight to avoid the kind of speculative excesses that we've seen in past cycles. So I'm sitting here thinking that, okay, all of these things, whether it's tariffs, whether it's regulation, it's not as simple or as reductive of saying they are good or bad. It's about aligning them into a coherent policy. Like, okay, stepping back slightly, there are lots of examples around the world, Korea, China, India, parts of Europe, after the Cold War, that have used successfully tariffs and deregulation as part of a coherent policy. But that's the point. It's part of a coherent policy. It's got to be carefully measured and not just used as a kind of bilateral negotiation tool as part of some idea that trade is a zero-sum game. It's about selectively protecting in certain industries, having an industrial plan and an economic plan that then is driven through using these two levers.
So, I mean, we're going to have key personnel changes at the SEC and the FDIC. Are we expecting then to see much lighter regulation? Because obviously one of the arguments, I mean, we had the global financial crisis in 2008. We had a sort of mini crisis with the Silicon Valley Bank a couple of years ago. And arguably, because it was a smaller institution, there was lighter regulation impacting the smaller institutions. And that was part of the reason why we had the collapse of that bank. I mean, I know it was an idiosyncratic event, but could we be dialing back some of the regulation that came into place then post global financial crisis? Is that what might be on the cards?
Yes, but if you look at where the current administration is focused, take an example. It's not, the US doesn't exist in a vacuum, particularly with something like global financial services that is truly global. So if you look at an area of focus over the last couple of weeks has been sanctions legislation, and the ability for speaking plainly, the ability for companies when negotiating agreements in other countries to use inducements and bribes. And there is a desire, I think, to roll back some of that legislation. But the point is that Europeans aren't rolling back that legislation. We in the UK aren't rolling back that legislation, nor is anyone else globally. And if you have a global business that is perhaps US based that wants to do business in those other regions, well, they're still going to abide by the legislation elsewhere. So it won't actually practically change anything.
They're freezing the enforcement, aren't they, of the Foreign Corrupt Practices Act,
exactly,
which essentially prohibits companies from bribing foreign officials, or prohibits US companies from bribing foreign officials.
Yeah, and for whatever reason, this has been targeted and singled out by the new administration. But as I said, it probably won't have any practical effects, because whilst a company wants to operate in multiple regions, it has to abide by European legislation, UK legislation, and elsewhere. So if a company is seen to be undertaking that activities just because it's not going to be enforced in the US. And then also you have, I won't get into the legals, you've got statute of limitations. Like, this ultimately has been decreed by executive order, not by a law passed by Congress. So in 4 years' time, I don't know, we could have another administration that looks back and says, no, actually that was illegal. So in 5 years' time, within the statute of limitations, you could find yourself prosecuted for something that ostensibly is not going to be enforced today. So I think when it comes to regulation, which was your topic, I think we just have to remember that, like I said right at the beginning, short-term catalysts for growth, potentially in certain sectors as part of a cohesive policy plan, but risks of eroding foundations of market stability in the medium to long term. So again, I would expect that after this flurry of initial announcements, I expect there to be a more gradual approach going forward.
And I think you make a very good point, which is that we need to be reminded that a lot of these are executive orders, which will cease to be enforceable when we have a new president in 4 years' time.
Yeah, and I think so. You've got we could spend the next sort of 20 minutes going through each of the various policies that have been enacted when it comes to deregulation. And the one that I think is potentially the most concerning actually is with research and development in biopharmaceutical industry, and the the pharmaceutical industry relies quite heavily on publicly funded research. And you've seen some changes in research. This is a $500 billion sector. Okay, that's more than steel and aluminium combined.
Yeah.
And you've got disruptions happening in research, which could slow medical innovation. And I think that a lot of the US's technological advantage in the sector has stemmed from strong public-private partnerships in research. Everything is related. Remember us a couple of months ago, well, in fact, it was about October last year, talking about the Draghi report. And Draghi used the US as a great example of how public funding, educational establishments, and industry, in fact, he used pharmaceuticals as an example, are fully aligned and integrated. And that's why the US has had such a technological advantage. So what you've seen over the last couple of weeks, sort of unpicking publicly available data sets, certain CDC posts, publicly funded research. Okay, in the short term, I wouldn't suggest there's going to be any impact. But if we think forward over the next couple of decades, well, things like this can have an impact. But remember, like you said, executive orders don't last forever. So let's see where we end up here. I think China, Germany, they're going the other way here. They're increasing R&D spending in this area using publicly funded, publicly directed policies.
Okay, let's come to the final topic then, which is geopolitics. And again, let's reflect on what was said going into the election, what we've seen happen in the last month. We've had some pretty big announcements come out, haven't we?
Well, with respect to the relationship with Europe, or relationship with Ukraine?
Well, I'm thinking also the fact that we've had the US and Russia meeting in Riyadh this week with a view to finding a solution with the Russia-Ukraine war.
Yeah, I mean, I think that with geopolitics, remember, political noise versus market resilience is what we're really debating here. Because if we go back and look at long-term effects of geopolitics, and we've discussed this a lot, if we look at Brexit, US-China trade war, Middle East conflicts, and we go back and use our Coutts data set over best part of 100 years, you can see that ultimately in the long term, geopolitical turbulence tends not to impact markets. I think if we take the definition of geopolitics as these kind of exogenous shocks, I think that's true. When we talk about tensions, trade tensions with global institutions, global allies, then I think you've got this slightly slower burn and important headwind. It is just a headwind. You've got these long-term innovation risks that I've already mentioned. Global cooperation in sort of key sectors like technology, biopharmaceuticals, climate change, and scientific research. So I think that you're talking here about to what extent will this sort of Pax Americana system that we've had since the Second World War come to an end or not? If you look at the rhetoric from European leaders, they're saying, well, they're encouraging European member states just to look through this current administration to whatever happens beyond. Look, I mean, I think it's realistic to say things aren't going back to the way they were. But equally, I think it's realistic to say things aren't going in an extreme the other direction. We'll end up somewhere in between. And the world is now gone from a unipolar world of US hegemony to one which is now multipolar with China, with Russia, with Europe and the US all competing geopolitically. So I think the policies will just reflect that over the next couple of years. I think you're going to, we talked, remember when we talked about our different styles of president, we talked about isolationist presidents and globalist, multilateralists. There'll be similarities, I think, with bilateralists and isolationists, but I think this next 4 years will be unique, but will have some similarities with that period, sort of in the 20s that we discussed previously. Already you're seeing it. You're seeing just the desire to do bilateral deals, not multilateral deals. So I think the geopolitics won't go away. It, in the short term, isn't going to impact markets, and investors shouldn't really get too concerned. I think we should acknowledge that volatility has been very low the last 18 months, 2 years. And the potential for policy surprise is out there. But Absent something truly radical, which I think is just a tail risk, what we're talking about here is just long-term structural shifts. So we should be mindful of them, watch them, but I don't think there's any reason to be concerned about them just yet.
Okay. On that note, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, David. Thank you for listening. Until next time on Need to Know, bye for now.